Welcome back to the channel. Today I want to walk you through a couple of market situations that could offer interesting opportunities. Over the next days, I'll keep it simple and focus on the four pillars I use in every analysis: seasonality, valuation, COT data, and supply and demand. Let's jump straight into the first one. On the right, we have the weekly chart. On the left, the daily chart. I always start with the higher time frame to identify areas where price might react. Here, we see an untested demand zone that originated from this rollover gap. I mark that area first and then switch to the daily chart to look for a potential entry that could improve the risk to reward. When we zoom in on the daily chart, we see that the actual gap won't be filled until price reaches this level. So entering directly at the weekly zone wouldn't make much sense structurally. A more reasonable approach would be to wait for the gap to close and then evaluate whether price could form a tradable reaction. As always, the stop-loss placement depends on your personal risk tolerance. In any case, this low should be monitored carefully, and arguably, this earlier low also matters, since it marked the start of the impulse that triggered this entire rally. Normally, we integrate COT data to see how large market participants are positioned. However, due to the recent government shutdown in the US, no new COT reports have been published for weeks. This should normalize soon, and once the data is available, it will be included in future analyses again. What we can use right now is seasonality. You've probably seen traders using seasonal charts, but almost all of them use them incorrectly. The typical seasonality curve you see online is simply an average of the last 10 years. The problem: if 9 years were slightly bearish and 1 year was extremely bullish, the average curve appears bullish, even if the actual win rate was only 10%. My tool works differently. It automatically scans the next 30 days and identifies the 10 best historical trading days, based on the actual success rate of the last years. This way, seasonality becomes a real statistical tendency rather than a random smoothing of outliers. No guarantees, of course, but significantly more meaningful than simple averages. The last component I use is valuation versus another asset. When the indicator dips into the green area, the asset is historically cheap, and when it's in the red zone, it's expensive. The more tools pointing in the same direction, the better. Ideally, valuation plus seasonality plus structure all align. Platinum is also an interesting candidate. Like most precious metals, it has been moving sideways at elevated levels. However, last week's candle looks rather bearish, and at the current level, nothing stands out as particularly attractive. There is a dynamic support area here, and if that level were to break, it could lead to further downside. The next clean area is visible on the weekly chart. From a risk-to-reward perspective, it would be preferable to find a refined entry on the daily chart. But when we look at that zone on the daily time frame, we essentially see the same structure. At the moment, platinum is fairly neutral relative to the dollar in terms of valuation. Our seasonality tool highlights the strongest seasonal window around mid-December, which coincides with the Santa rally period in US indices. Since there is still time until then, we could simply wait, observe price behavior, and check the COT data once new reports are released. Ideally, price reaches the zone at a time when it is also favorably valued against the dollar. This setup is not the easiest and requires some thought. On the daily chart, multiple stop-loss options exist, and as always, there is no absolute right or wrong. It depends entirely on whether you prefer a wider cushion or a more optimized risk-to-reward. What do you think about these ideas? What's on your watch list right now? Share your thoughts in the comments, and make sure to check back next week for the latest analysis.